Good. How are you? How you been?
Doing well, man. Thank you.
Awesome. Well, you're good to go. Stage is yours. Take it away.
All right. Let me just grab my sheet. What is going on, everybody? Welcome to this week's webinar. And I hope everyone has had a happy past few days of trading. The market is absolutely booming. It's I have it up right here. I mean, this is it's I can't I've got no words to describe what Nvidia has been doing. Fortunately for me, I've held it for quite a while, but that is besides the point. Today we have investment buzzwords. That's the title of the webinar, and that's what we're going to go over. I've compiled a list here of several different buzzwords. Not hundreds, but I've got a lot of them. These are words that maybe you hear on various investing threads or perhaps on CNBC, just to give you a little bit of clarity about what they mean, what the applications of it are. And if you were to look at any kind of fact sheet or any kind of um, a 10Q, an earnings report, or anything of the sort, these are some of the words that you would find on there. And I hope that this is able to help you understand what you're reading a little bit better. So start alphabetically, and the word alpha, you might have heard alpha, positive alpha, negative alpha. So alpha is essentially the amount of return expected from an investment from its actual value. So obviously you're going to want alpha to be as high as possible. If an investment has negative alpha, get rid of it. So we'll go over beta as well, but in terms of how stocks perform, the terms are Greek terms. So alpha, there's beta, there's no gamma, there's delta. No, I don't think so. But those are really the only two that are meaningful. So alpha, when you think alpha, strong individual, you want those returns to be strong. So positive alpha, good, negative alpha, bad. You might also hear, especially for retired individuals, AMT, which stands for alternative minimum tax. And that is, if someone is, if, for example, you have a grandparent or something, and you ask them if, hey, grandma or grandpa, are you subject to AMT? They will absolutely know about it. And if they say they don't know, that is something to find out because it could impact them. So essentially, alternative minimum tax is a federal tax. It was revamped by the Tax Reform Act of 1986. And it's aimed at ensuring that wealthy individuals, trusts, estates, and corporations pay at least some tax. So a lot of times, individuals and trusts and corporations, I'm sure you've heard on in the news that Donald Trump, along with various CEOs, somehow they never pay taxes. Well, some they yeah maybe they don't pay taxes, but they take their income in the form of debt, or they take their income in the form of um, investment income, or what was the other word? Carried interest. Carried interest is is the word that I was looking for. Carried interest means that that is their return, a specific amount of interest that they receive off of their investment. So they're not going to be paying income tax on that. That's going to be investment income tax on that. So if someone's subject to AMT, it's just to make sure that the IRS is going to do a little bit of extra due diligence on them to make sure that they're at least paying some tax. And I'm sure you've heard it's earnings season. You'll hear a lot of analysts and people on CNBC talk about an annual report. An annual report is the yearly audited record of a corporation or of, it doesn't have to be a corporation. It could be also like a mutual fund's condition and performance that is distributed to shareholders. Easy enough to remember. When someone says that these figures are annualized, annualized is a procedure where figures covering a period of at least 1 year are extended to cover a 12-month period. So annualized, just think of annual, annual is a year. Those are figures over 12 months. Pretty easy to think about there. Annualized rate of return is the same thing. So I wrote annualized or annualized rate of return. It's the rate of return that happens over a year. So this one is rather self-explanatory, but appreciation. Appreciation is an increase of value of a financial asset. So by financial asset, I mean any asset that costs money. So a car can appreciate, stock can appreciate, bond can appreciate, house, anything really can appreciate if you have purchased it. Now we have had webinars about this buzzword in particular, and that is asset allocation. And asset allocation is the process of dividing investments among cash, income producing investments, growth producing investments, among various different sectors, among various different investment vehicles. So allocating assets in a way that achieve a certain investment objective, whether it's income, whether it's growth, whether it's whatever it is. Looks like my father's calling me in webinar. All right. So, and we've had an excellent webinar about asset allocation in the past. And so when I said asset class before, an asset class is essentially a security with similar features. So the most common asset classes are stocks, bonds, cash equivalents. Asset class could also be ETFs, which we've talked about before. It's a buzzword. I'll talk about them again. Mutual funds, all of those are asset classes. Okay, moving on to Bs. So one that I think gets thrown around a lot, and I don't think some people who are not savvy investors, and that's okay. You could be a beginner, absolutely fine. But a bear market. So you'll hear people on CNBC talk about a bear market. And a bear market is a prolonged period of falling stock prices. So usually marked by a decline of 20% or more. So a market where prices decline sharply, growing unemployment, business recession, that's going to be a bear market. So if you ever see on Wall Street or any really kind of bull market, bear market, I'll go through a bull market real quick. A bull market is the opposite, is where it's a period of prolonged increasing, advancing upward trends. Good. We like bull markets. Being bullish on something means that you believe that it is going to do well. If you are bearish on something, that means that you think it's going to do poor. So bull and bear is opposite. If you ever see the famous sculpture on Wall Street, it's a big bull. So we like bulls. We like bullish sentiment is often what they call it. So the thing with the bull and the bear, you might think, oh, bear is a predator. Bear shouldn't the bear be the triumphant one? It's actually the bull. The bull is much bigger. It's got the horns. The bear kind of cowers to the bull. So the bull is the height and the bear is the low. So that's what that's all about. Another one that gets thrown around a lot is a benchmark. Think of a benchmark as a standard. Okay. So an exemplary example. So a standard is probably the best word to use. So usually a benchmark in the stock market is an index, such as the S&P 500. How well is this particular stock, or how well is this portfolio doing according to its benchmark, according to the S&P 500? If it is higher than the S&P 500, it is beating its benchmark. If it is lower than it, then it's below the benchmark. I think you get that. So the next one we're going to go over is beta. Beta, we were talking about alpha before. Alpha meaning, how much return an investment is producing. You want that to be positive. Beta is a little bit different. So beta is a measure of volatility where one is neutral. A beta of one is as volatile as the market. That's okay. A beta of one is fine. A beta of less than one means that it is less volatile than the market. A beta of less than one, you're going to find is a little bit more balanced. Maybe it has a little bit more fixed income in it, fixed income meaning bonds. So a beta of greater than one means it's going to be pretty volatile. That is an aggressive investment style, and you should maybe reconsider if you don't have that much, if you're not able to take on that much risk. Another one that gets thrown around is blue chip. Blue chip. Well, I know what a blue corn chip is. Those are delicious, but I know what Bluetooth is, and no, blue chip. So blue chip, when someone refers to blue chip, the blue chips, they're talking about a classification of stocks. So blue chips are high quality, relatively low risk. These are when I say low risk, okay, so if you're investing all in stocks, that is technically risky, okay? Those stocks have the propensity to go up and down as time goes on. However, a blue chip, a company like Amazon is not going out of business anytime soon. Apple definitely not going out of business anytime soon. These companies refer to stocks that are large, well-established companies that have performed well over a long period of time. So I think where the word blue chip comes from is referring to poker. So the blue chips are the most valuable. It makes sense. I think the blue chips are the most valuable ones to have when you're gambling. So they talk about companies in the same way. So the blue chip stocks, the best stocks, strong leadership, strong fundamentals, strong balance sheets, fantastic companies to invest in. Buy blue chip stocks. You might hear people talk about the board of trustees when they're referring to a company. So the board of trustees is a governing board of elected or appointed individuals to direct the policies of that company. Board of directors, board of trustees, same thing. BOD, BOT, same thing. So moving on. We had a whole webinar about bonds, but I'll just give you a little recap. Consider a bond as purchasing debt. Okay. It can be issued by a corporation to raise money for a particular event or occurrence or if they're trying to grow the company, they got to issue debt. You'll pay them back. You'll buy the debt from them. The company will pay you back with guaranteed interest, and the bond has a maturity date. Same with the municipal bond. The municipality will issue a bond if they want to build a bridge, if they want to update the sewer system, if they want to build a new school, hospital. They'll issue debt. You'll purchase the bond, and the municipality will give you an interest rate in return. There's, like I said, maturity. At the maturity, you get your principal back. But in that meantime, you're getting that guaranteed coupon rate. Coupon is another word for yield. Think of it that way. All right, moving on. So going into C. So if someone is referring to capital, capital can mean a couple of things. Capital can mean cash. Capital can mean equipment. Capital can mean anything that holds value a part of a company. So if someone's trying to get rid of capital, they might want to get more specific about what exactly they're trying to get rid of. Okay. Capital gain. Okay, what does that mean? Capital gain, capital loss, realized gain, unrealized loss, unrealized gains, realized gains. So a capital gain is the difference between the security's purchase price, the price at which you purchased it versus its selling price. Okay, and what obviously you want that difference to be positive. So just a capital gain means you have made a gain on your investment. Simple as that. If you have not lost anything and you have not gained anything until you sell it. Okay. With that said, a realized capital gain means that you have actually done the action of selling that security and have obtained that gain. Unrealized means you see it in your portfolio, or an unrealized gain or an unrealized loss means that you see it in your portfolio, but it's going to continue to fluctuate because you haven't quite sold it yet. All right, going on. Capitalization. This is a big one. So when someone refers to a market cap, okay, uh, market cap, large cap, mid cap, small cap, micro cap, mega cap, NVIDIA. Shout out NVIDIA, making a lot of money over here. Capitalization or cap is the market value of the company calculated by multiplying the number of shares outstanding by the price per share. So naturally, companies that have a larger price per share are going to have a larger capitalization rate. So mega cap companies are going to be, you know, the giant seven, ones that Meta and Microsoft and Google. I don't know if Google is actually NVIDIA. Ones that can have major sway, it can cause the market to have a major sway, just with a slight up or down movement in their share price. All right, let's keep going here. Let's see what else. Some of these are diversification. That is a buzzword, but I wrote that and I wrote that down, just any of them that came to my mind. But diversification, we all know what that means. I don't even need to explain myself. If you don't know what it means, that's okay. Just look it up. So dividend, a lot of people don't understand what a dividend is. That's okay. We've gone over them in other webinars. So a dividend is pretty much a way for a company to say thank you for being a shareholder. It is a portion of a company's profit paid to the common stock and the preferred stock shareholders. So it can create an incentive to own stock. It can be a way to generate income from your investments. A company does not have to give a dividend if they don't want to. A company that does not give a dividend is going to grow a lot quicker than a company that does. Amazon does not give a dividend. Tesla does not give a dividend. That's okay. They grow a little bit quicker than companies with a dividend because the companies are giving away some of their profits back, millions and millions of dollars of worth of profits back to the shareholders. But in return, the shareholders can take the income, the dividend as income, or they can reinvest for more shares. Dividends are very important in our line of work, and we appreciate them tremendously. Dividend yield is just the percentage of dividends. So, for example, let me just tell you real quick. The dividend yield of Ford. Okay, Ford gives Ford trucks. They give a 4.93% dividend yield. So you're going to get 4.93% annualized, buzzword from earlier, an annual rate. You're going to get 4.93% annualized per year, and they'll pay it out either monthly, quarterly, usually monthly or quarterly, more often than not quarterly. For example, let's see another one. Apple gives a small dividend, but Sunoco, the gas company, we all pump our gas. They give a 7% dividend. AT&T and Verizon also give very solid dividends. So that's what the yield is. Dollar cost averaging, another great one. So dollar cost averaging, DCA, that is investing the same amount of money at regular intervals over extended period of time. So when you are constantly reinvesting your dividends, given that dividend yield, buzzwords from earlier, when you are constantly reinvesting the dividends month after month, year over year, you are dollar cost averaging. You are repurchasing shares of a stock at various prices. Dollar cost averaging, your average cost per share is going to be a lot lower in the long run. Let's keep going. EPS is earnings per share. So earnings per share is the portion of a company's profit allocated to each outstanding share of common stock. Okay, so EPS serves as an indicator for a company's profitability. A company with a high earnings per share is going to be an excellent stock to own. Okay, so earnings per share, EPS, that's a good one. I got so many people calling me today. I apologize. Let's see what else is on here. Expense ratio, I've gone over this one before. So if it's just another word for a fee, okay? So if a mutual fund has an expense ratio of 75 basis points or 0.75% or 0.75%, that's the fee that that mutual fund is charging you. So that's an expense ratio. Let's see. This is a good one and a timely one. The federal funds rate. So the federal funds rate is an interest rate that is charged by the banks with excess reserves at the Federal Reserve to banks needing overnight loans to meet certain reserve requirements. Banks have reserve requirements. Banks have to have a certain amount of money in the bank at all times for their reserve requirement. And so the federal funds rate is the interest rate charged by banks to I think I'm mixing up my wording a little bit. So the interest rate charged by banks with excess reserves at the Federal Reserve needing overnight loans to meet reserve requirements is exactly what it is. Okay. And so when people go to say the Fed, the Fed this, the Fed that, that's the Federal Reserve Board, and that's the governing board of the Federal Reserve System. Okay, they regulate the nation's money supply by setting the discount rate, tightening or easing the availability of credit in the economy, in the country. So that's what the Fed is. Okay. Let's see. What else? Let's see. I have growth stocks on here, but that's very self-explanatory. An index, okay? An index. Oh, the index this, the index that, the indices. The investment index tracks the performance of many investments. For example, the S&P 500 index. The S&P 500 index tracks the performance of the top and or largest company, top 500 companies in the United States. Okay, that's an index. An index can also be a benchmark. So that's what that's all about. Now, this one, I think everyone kind of has an idea of what this is, but this is 100% a buzzword. Inflation. Inflation is really just the rise in the price of goods and services, which as a result results in the loss of purchasing power. When you're paying more for goods and services, your purchasing power goes down. When you're paying less for goods and services, your purchasing power goes up. Inflation. We're in an inflationary time right now. When it's less expensive for companies to borrow, meaning when the interest rate comes down, inflation will also go down. when companies have to pay more to borrow money for their operations, they got to charge more for their goods and services. When they don't have to pay as much anymore, they're going to lower the price on their goods and services. So that's an important one, and that's a very timely one as well. Let's see what else. Maturity. So maturity goes for a few different things. Maturity, it's not just the time a young man or young woman, the time it takes for them to grow into a man or a woman. But maturity in terms of investments is the date specified on a note or a bond at which the debt is payable slash due. Okay, so let's say I purchased a bond, buzzword from before, a municipal bond. Say the maturity is 10 years from now. In 10 years, there's a maturity date. Okay, let's just say it's February 23rd of 2034. Okay, seems like a long ways away. But so the maturity date is that day in 2034. On that exact day, my money will come due. I can collect my principal and I can be on my way. That's the maturity date. Now, let's see what else. What else? Money market. Money market this, money market that. I'm sure you've heard of it. You know, it's profitable to be in the money market right now. You can make money on cash. So the money market is essentially a short-term investment that is principal that seeks to protect principal and generate income by investing in treasury bills. So money market account at a bank, or a money market fund at a broker-dealer, it's essentially a cash alternative. You're guaranteed not to lose anything, but you're also guaranteed not to gain anything. But you're gonna get an interest rate in the meantime. Okay, so right now my money market that I offer at my broker-dealer is 5.4%. So if you have $100,000 in my money market, you're going to be getting $5,400 a year in interest. Okay, it's investing in the treasury bills. Easy enough to think about. You might also hear people talk about par value. So par value, when you are referring to a bond's maturity, buzzword from before, bonds mature at par. Par is 100. If you buy a bond at $99 a share per bond, that bond's at a discount. If you buy it at 100, you're buying at par. If you're buying the bond at 101, you're buying it at a premium. You definitely want, so if you buy it at a discount and it matures at par, you're going to have a capital gain because it's going from 99. You bought it at 99 and then it's going to be selling at 100. If you buy at par and it redeems at par, then you're just getting your principal back. You buy at 101, it redeems at par, you're gonna lose some of your principal. That's what par is. Let's see what else. Okay, so price to earnings ratio, PE ratio. It's the stock's price divided by its earnings per share, which indicates how much investors are paying for the company's earning power. So PE ratios are often something that an analyst will take into account when including or excluding that particular stock from a portfolio. Okay. Oh, this is a good one. So proxy voting, proxy this, proxy that. A proxy is what is sent to a shareholder of a stock to vote on matters that require shareholder approval. As a shareholder of a public company, if you own shareholder is another word for a stockholder. If you own stock in a company, you are considered a shareholder. You have voting rights. You can vote for the board of directors. You can vote to increase or decrease the dividend, only when asked. You can't just write to them and say, "Oh, I want this person off of there." So that vote is called a proxy vote. Proxy proxy. Hmm. Let's see what else. I don't know if I have a whole lot of other ones. I guess treasuries. I mean, people have been hearing T-bills and T-bonds, T-notes. So a treasury bill is a short term, usually less than a year. It's a debt obligation issued by the US government, backed by the full faith and credit of the US government. So it's essentially by buying a government CD is what it essentially is. So it's protected. Interest rate is going to be whatever the treasury rate is for that day or week. Um, when you buy a CD, it's protected by FDIC. Treasuries are backed by the government, full faith and credit of the US government. When people refer to the valuation of a company, that's the estimate of the value or worth of a company. Valuation, value, you get that. I think that's pretty much it. Actually, one last one. Year to date. It took when I was first starting out of business, I couldn't understand what year to date meant and now that I think of it, it's just so easy. So year to date, YTD, you'll see. Year to date means what the particular investment returns have been, the performance has been from right now since the beginning of this calendar year. So from right now till January 1st of 2024, what has the stock done? So for example, or the index. So for example, the year to date performance of the entire S&P 500 index is 6.7%. So since January 1st of this year, the S&P has done 6.7%. And that'll fluctuate throughout the day. Nvidia year to date up 61%. It's a if you are early in the year to date is not a great measure of performance. Midway to end of year is a fantastic way to measure performance. So I hope you all enjoyed this. I hope it was helpful. I hope I was able to clear up a couple of things for you guys. If you have any questions, reach out to me on Instagram at the Wes Gottesman or on TradeZing at Wes. I'm happy to answer any and all questions. We do these webinars twice a month, usually on Fridays at 2 p.m. Eastern Standard Time. Also, make sure to check me out on the TradeZing app or on the webpage under Community Audio Rooms, as I host an audio room Monday through Friday, 4 p.m. Eastern Standard Time after the market closes. I go over my afternoon commentary from the day before, what happened this morning, what happened intraday, and then any other notable news that I think would help that I think would be impactful in your trading. So with that said, I hope everyone enjoyed today. Thanks again for joining, and we will see you next time. Enjoy your weekend. Have fun. Be safe. Bye-bye.